Okay, in this final video, we'll continue talking about analyzing common stocks, and we'll look at questions about debt and performance, profitability, as we conclude our fundamental analysis of a company. So leverage ratios essentially give us a picture, if you will, of how the company purchases its assets. Does it purchase its assets by borrowing a lot of money, or do they primarily use profits and shareholder money? So we want to ask a couple of questions. How much debt does the company have? And then are they able to make payments on that debt? Can they service the debt? So the first ratio talks about the debt equity ratio. This shows us in relative numbers how much long-term debt the company has compared to common equity. In other words, what's the relationship between the amount of long-term borrowing to buy assets and the use of shareholder investment money to invest to buy assets? As you can see here, in general, Disney is fairly stable with the exception of this fourth year here, but in general they're in the upper 40% range. So it appears that the relationship is that they borrow, if you think about long-term borrowing, about 40% of their debt is represented also by the common equity. So in this case, if this number gets very large, this number could be greater than 100%, which would mean that they borrow more money than what they use in shareholder money. So in this case, they're using more shareholder money to buy assets than they are borrowing to buy assets. The equity multiplier gives us a relative picture of their use of debt. In this case, it is total assets divided by common equity. So this says, look, of all the assets that you have, how much of those assets were purchased using shareholder money? And in this case, if you look at the final year, these are all fairly stable. Their financing is fairly stable. Give or take, they're right about 1.9 to 2.0. That they have twice their assets, about 2 times the amount of assets is purchased with common equity. So basically that means about 50% of their debt, their total debt, is common equity. Everything else must be some form of financing, some type of borrowing, if you will. Again, the bigger the number here indicates that more debt is being used. So generally, we would like this company to be a little bit lower so that we should reflect maybe less risk. The final ratio is the times interest earned ratio. Again, they basically say they like this number between 8 and 9 times. It's pretty strong. In this case, you can see that the company has a very high number relative to the general rule. So we would say that this company, not only do they have low amounts of debt, but they have a great ability of to pay off any interest payments that they currently have. So there is room, if the company decides that it wanted to, there is room that this company could borrow and not adversely affect the riskiness of the company. If we look at profitability ratios, there are several things we want to look at. The first thing we'll look at is the income statement. And these ratios reflect managers' ability to control expenses. So if we look at the bottom line, net profit margin, again, across the board, you see that it's a fairly stable company. And the last couple years, it's been over 16% is how much is the bottom line, if you will, of the company. So said another way, the net profit of the company, 16 cents out of every dollar of sales ultimately could go to the owners of the company. net profit margin, the profits of the company, belong to the owners. Now, gross profit margin reflects how they control expenses of production. And again, as we look across the line, we find that Disney is very consistent. Their performance is stable. So 45 cents of every dollar goes to production. Operating profit margin talks about how they control all the expenses of operating the business. Again, that's 25 cents of every dollar goes to running the company. So again, this gives us a picture of how well managers ultimately manage and control the expenses of running the business. Another ratio, two ratios to look at actually. One's called return on assets. This looks at management's efficiency in using the assets of the company to generate profits. The last ratio looked at the relationship between profits and sales, right? So that's what we were looking at there. So return on assets says, look, 7.55%. Goes along with it. Again, the last couple years have been very, very good. Again, fairly consistent percentages here. That it appears that about 9% that from the total assets of the company, they produce about 9% of the profit is coming from this assets, how efficient they are. Again, we like it to be higher rather than lower, but this company seems to be pretty standard. Now, one of the things that we might want to do is make some comparisons. And as a general rule, return on assets is very difficult to compare to other companies or to other industries, basically because of the financing differences in companies, right? So here you see net profit is the bottom line, so it assumes, or in that number is the financing choices of the company. Well, one company might be different from another company. So BEP is the basic earning power, is just a better number to use because it looks at earnings before interest and taxes. So we don't have any influence of the tax expense of the company, and we have no influence from the financing choices of the company. So it's just a better measure of management performance. And again, we find that in general, the company is fairly stable with respect to its profitability. Return on assets reflects the amount of return that is essentially earned on the investment of shareholders. So if you look at this, it's net profit divided by common equity. So again, a higher number is better than lower, and if this number is declining fairly rapidly, we want to pay pretty close attention to that. And as you can see, in general, we've had some fairly decent growth in return on equity for this company over the past 5 years. Again, around 17% is the return that investors are seeing from the profits of the company. So one of the things we might want to do is do some type of an analysis. And they talk about your textbook about breaking down return on assets and return on equity. And quite simply, this is really just a multiplication, if you will, right? If you take the net profit margin and multiply it by total assets, you get return on assets. So we would like to know what is how is this profit being generated? We see that most of the activity, since total asset turnover is rather low, most of the profits from the assets that the company has purchased is obviously being created by operations, not the efficient use of assets, but through the profits within the company. Now, return on equity then is return on assets times that equity multiplier that we had. So where does the profit to the owners come from? Does it come from leverage, or does it come from operations? So again, we can look at relatively how this has changed over time. Now, it's really a much better picture if you think about making comparisons to industries and competitors, because we can see where the strengths of the company might ultimately be. So the next set of ratios that we want to look at, they refer to them as being common stock ratios. I prefer to think about valuation ratios or market ratios. So essentially what we're looking at now is the stock price. How is the company's stock price relative to some line items in the financial statements? So we've already talked about earnings per share in previous videos. And of course, you can see here that there's been increasing earnings per share up until this last year, a little bit of a decline in earnings per share, right? So again, that is just a measure of profit that is owned by the shareholders. Now, the PE ratio is a number that reflects optimism by the owners of the company. As you can see here, in the first couple of years, the PE ratio is above 20, and then it starts to decline. So again, it's fairly stable. There's not that much change, but it does appear relatively that shareholders have lost a little bit of their confidence in the company. Again, it's not dramatic. There's not a terribly big change here, but it does show what? A decline basically tells us that owners have lost a little confidence in the company. That is, they're not willing to pay a high price to get the profits of the company itself. Now, there is a ratio called the PEG ratio. And the PEG ratio basically is a picture. It's the price earnings growth rate. You take the PE ratio, so earnings created by the company, right? How investors view the company's value, and you divide it by its growth rate in earnings. Maybe we use a 3 to 5 year growth rate. So how you analyze this, if the ratio is greater than 1, then the stock is assumed that it's probably fully valued. So a PEG ratio greater than 1 means this stock is possibly overvalued. If the PEG ratio was 3 or 5 or 6 or higher, we might be thinking, okay, the stock price is much too high. It's going to fall pretty soon because it could be overvalued. And of course, vice versa, the stock is undervalued for PEG ratios less than 1. So if you're searching for companies, a good place to go is the PEG ratio. You want to find a PEG ratio less than 1. It's an indication that the stock price might be too low. Now, for this company, again, if we think about it, the only number we really have, because I don't have this growth number, is 19.09 was the last PE ratio for this company. So, what would the growth of the company have to be, growth rate of earnings, what would that have to be just to get us equal to 1 so that it would be in line with earnings? Well, it would have to be 19.09%. So again, if it was, can you imagine a company having a growth perspective or prediction of 19% per year? That sounds like a very high number. So what we might be thinking about then is this stock is probably overvalued, because you're not going to find a number bigger than 19% in their growth rate. And in fact, if we look at Disney's average growth from their financial statements, it turns out to be about 10.42% is the average growth of their earnings. So that gives them a PEG ratio of 1.83. So what they're telling us is that essentially this company's value, it might be a little overvalued. Again, it's not much over 1, but we do want to pay attention. If it would get much higher, we might think that the company is becoming overvalued. Another number that we're certainly interested in is dividends. And here you can see how much of the company's earnings are paid out as dividends. You can see on general, it's in the upper 20s, right? Every once in a while, it's a little bit higher, right? But we see that this last year, they paid out 27% of their earnings were paid out as dividends. That means that they have retained 73% of their money. So what do they do with that 73%? They're reinvesting that into assets of the company. Maybe they're buying more assets and equipment, plant and property. Maybe they're buying other companies. But a high payout ratio means that the company is paying most of its earnings to owners, which means they're not reinvesting in the company's future. If we look at another ratio, it's called the book value per share. We've defined what book value is, but essentially it's the common equity divided by the shares. Now this is a historical number, right? It's looking at the past because accounting statements are all made in historical context. But it turns out here again it's fairly stable. The last year was around $33 is the book value per share. So think, if you wanted to build a company that looks exactly like this company, it would cost you roughly $33.33 to buy this or to build this company by building its assets. The next ratio looks at that number relative to the stock price. So again, most stocks are going to have a price to book value greater than 1. And in a really good market, it could be 4 or 5 or more times their book values. But essentially, this is a good ratio to tell you how managers are performing for their owners. If this number is greater than 1, it means they are creating more value than what the company is worth on the books. And you see here for Disney, we can see that over the time frames, it's fairly steady, but it's in the mid-3 range on average. So it would take 3 times more money to buy the company by buying all the stock than it would be to build the company. So this would be a company that would be very difficult to buy all of the stock. It wouldn't be very attractive because it's too expensive to buy all of the shares of the stock rather than building the company from the ground up. So how do we interpret these things? Again, essentially what we're looking for are trends, right? We want to be able to understand the basics of what the ratios mean and how we can employ that to make good investment decisions. Other ways that we can use this, again, we have only been looking at the company historically. We also might want to look at ratios for the industry or to the competitors. This will give us a better view, if you will, of how the company stacks up and where it fits in the hierarchy or the rankings, if you will, of a company in general in its industry or compared to its competitors. So again, this fundamental analysis gives us a picture of the different decisions that management makes. Management makes decisions about buying assets. Those are the efficiency ratios we talked about. They make decisions about profitability and expenses and operations. Those are the profitability ratios. They make decisions about financing. Those are the leverage ratios. And in the end, shareholders evaluate a company and they decide through supply and demand mechanism what the price is. So shareholders essentially create the price, which creates those price ratios or the market ratios, which gives us a picture of how current owners view the operations and the decisions that management makes. So again, that is the final part of analyzing common stocks.